The signals are flashing, the warnings are all stacking up, and some of the biggest names in finance, they're making moves that, in the past, have come right before a major downturn. So are we on the brink? Let's break down the evidence. It's the question on every investor's mind, and it's a stark one. Is a stock market crash coming in 2026? Well, a lot of evidence is starting to pile up, and it all starts with a few key numbers. First up, 39.8. That's a valuation metric that is screaming from levels we've only ever seen right before a catastrophic correction. Then there's this number, 2,997 points. That's a reminder of the largest single-day drop in history, a brutal, gut punch of a number that just shows you how fast everything can unravel. And finally, $187 billion. This is a massive figure, and it's tied to the world's most famous investor. It's a number that represents not what he's buying, but what he's selling. Stick around because we're going to connect all these dots. All right, let's open the case file. Exhibit A, valuation alarms. This is our first clue, the price of the market itself. And let me tell you, it looks like it's being stretched to a potential breaking point. Our key piece of evidence here is something called the Shiller PE ratio. You'll also hear it called the CAPE ratio. Now, don't let the name intimidate you. Just think of it like a long-term price tag for the stock market. It smooths out earnings over 10 years, which gives us a much clearer picture of whether stocks are cheap or, in this case, maybe dangerously expensive. And right now, what's that price tag reading? A whopping 39.8. To put that in perspective for you, most economists start getting really nervous when this number climbs over 32. So yeah, we are well past that. We're deep in the red zone. And this is where the alarm bells get a whole lot louder. We've only seen valuations this high twice before in history. Once in 1929, right before the Great Depression, and again in 2000 at the absolute peak of the dot-com bubble. That is not exactly comforting company, is it? And you can guess what happened next, right? It wasn't pretty. Historically, after the CAPE ratio got this high, the market got hammered. We're talking an average drop of 4% after just 1 year, but it got much worse, plunging to an average loss of 30% after 3 years. Now, history doesn't always repeat itself perfectly, but boy does it often rhyme. Okay, on to our next piece of evidence. Exhibit B, the economic harbinger. The case keeps building as we move from the market's price tag to a classic, almost legendary predictor of economic trouble. This is the yield curve inversion. Now, normally, you get paid more interest for locking your money away for a longer time. Makes sense. But when that flips, when you get paid more for a short-term bond than a long-term one, it's basically the bond market shouting from the rooftops that a recession is on the horizon. It's one of the most reliable indicators we have. And guess what? That alarm has been blaring. The U.S. yield curve was inverted from October 2022 all the way through the end of 2024. But here's the kicker. The signal isn't immediate. Economists are now laser-focused on the 18-month window after it ends. You do the math, that puts the spotlight for a potential crash squarely on mid-2026. So the data is one thing, but what about the human element? Markets are made of people, after all. That brings us to Exhibit C, the voice of the herd. Let's talk about the psychology of the market itself. This is the famous magazine cover indicator. The theory is brilliantly simple. By the time a hot investing trend makes it to the cover of a mainstream non-business magazine, the smart money is already out. It signals that the market euphoria has hit a fever pitch, the absolute peak. Now, for this to be a true signal, its creator, Paul Montgomery, laid out 3 rules. 1, it has to be a mainstream publication. 2, the concept has to be widely understood. And 3, it has to follow some huge gains in that asset. When you see all 3 of those things line up, it's a powerful contrarian sign. But we can get even more specific. There's this fascinating academic idea called verb convergence. This is when financial journalists all start using the same uniformly positive verbs, words like soared, rose, climbed. This kind of linguistic herd behavior signals a dangerous consensus, a sign that the market is often about to violently reverse course. And the proof is, well, it's stunning. This model here tracked the language and the financial news. That's the red line. Notice how it peaked at the exact same moment as the market itself, the purple line, right before the last major crash. It's a shocking visualization of groupthink in action. Which brings us to our final and perhaps most damning piece of evidence, the verdict. Forget what people are saying for a minute and just watch what the smartest person in the room is doing. For 13 consecutive quarters, that's over 3 years, Warren Buffett's Berkshire Hathaway has sold more stock than it has bought. This is a sustained, deliberate pattern of selling from the man they call the Oracle of Omaha. And the total amount of those sales, $187 billion. Yep, that's the number from our intro. It's the amount of capital Buffett and his team have pulled out of the market, which suggests they simply can't find anything worth buying at these prices. So where did all that money go? Right here. An unprecedented 28% of Berkshire's portfolio is now just sitting in cash and bank deposits. That is the highest cash allocation in the company's entire history. He's not just selling, he's stockpiling ammunition, waiting for prices to finally fall. So let's just review the evidence one last time. We've got historically high valuations, we've got a textbook recession indicator, we've got psychological herd behavior, and on top of all of it, we have the smartest money in the world quietly heading for the exits. Each one of these signals on its own is a warning. All of them together? That's a pretty compelling case. The evidence is compelling, the patterns are familiar, and the timeline seems to be pointing right at 2026. So the only question left is history about to repeat itself? To make sure you see the next signal before it's too late, subscribe for more powerful insights. And hey, like and support the channel. Stay sharp out there.